What's up, everybody? Today we are talking about Best Buy. The stock pays a 4.97% dividend yield. They almost went out of business back in the 2000s, but they have rebounded and came back strong. They just reported earnings. It was a really strong result. You can see the shares are up 10.3%. So today we're talking about Best Buy's dividend, how much they've grown their dividend over time. And then if you stick around to the end of the video, I'm going to tell you the exact price that I would buy the stock at. All right, you can tell the stock is down 23% year to date. Over the last 5 years, it's up 37%. Over the last 10 years, it's up 512%. And then since 1993, it's up 5,899%. Talk about long-term investing, right? So why is the stock up so much today, and is it undervalued right now? Should we be thinking about buying the stock right now? Well, first of all, they reported $1.38 in adjusted earnings per share when they just reported earnings, which was over the estimates of $1.02. So they crushed those estimates. They also had $10.59 billion in revenue, which also beat investments. When companies beat investments, they tend to do well over time. They had a really strong year last year, and then they had a 10.4% decline in comparable sales this year from last year. But it wasn't as bad as analysts were expecting, right? Analysts expected a 13% decline, so they're still doing okay. Biggest thing for them is they are keeping their inventories under control, meaning they're not spending excess on shipping and inventories and storage and all kinds of stuff and then losing money to discounting. They're managing their inventory and the supply chain well. And their CEO talked about that on the call or in their earnings notes. They said, throughout the quarter, we were committed to balancing our near-term response to current conditions, managing well what is in our control while also advancing our strategic initiatives, investing in areas important for our long-term growth. And then they strategically and effectively manage inventory based on shopping patterns of historical trends, not just kind of the last COVID year's trends. And the reason the stock is bouncing so strong today is that they said, their CFO said, based on the Q3 strength and optimism into the holiday season, management raised the guidance for the full year. The company now expects a 10% decline in comparable sales year over year compared to 11% decline, which is above the 10.8% drop anticipated by analysts. So they also think the stock is cheap, right? They bought back shares. They said we resumed share repurchases in November after pausing Q2 and now expect to spend approximately $1 billion in share repurchase this year. So when you see a stock bringing shares down, that makes every share that an investor owns worth more because there's less shares out there. So I like to see smart capital allocation like this, where they're not just blindly doing their capital reallocation or repurchase plan. They actually waited. The stock came down and now they have repurchased shares in November and they're going to continue repurchasing. All right, now let's talk about what makes this such a special dividend growth stock and why dividend growth stocks are so powerful for investors that want to have outperformance over time and grow their dividends over time, but also have share prices that go up over time. And so you get that capital appreciation. And again, stick around to the end where I'm going to tell you the price that I would buy the stock at. So this is Simply Safe Dividends. They give them an 80 dividend safety rating. They had 26% dividend growth in March of 2022. They do have a 42% payout ratio, which is getting high for retailers, so something to pay attention to. Their forward payout ratio based on future earnings is 57%, also high for retailers. They have low net debt to EBITDA, but they have high or edging high net debt to capital, at least for consumer retailers. They have paid a dividend for 18 years without a reduction. They actually maintained their dividend from 2007 to 2009. Their sales went up from 2007 to 2009 because they were such a smaller company back then, but shares got crushed back then, down 49% during that recession, right? We can see this is what makes it such a special dividend growth company. 26% in March of 2022, but over the last 5 years, they've averaged 20% per year, and over the last 10 years, 17% per year with 18 years of dividend growth. And so you can see from a valuation perspective, right? The dividend yield is higher than normal, which might indicate that a stock is undervalued because when the share price goes down, the dividend yield goes up. But they've also increased their dividend a lot, right? So this 5-year average is something to it's not as relevant with Best Buy as it is with some others. Their forward PE ratio is a good thing to look at. Over the last 5 years, it's averaged 13.5 and it's currently sitting at 12.7. So it at least looks like it's in line with fair valuation, right? So this is another little quality check for companies. This is Everything Money. They have this 8-pillar analysis that kind of just tells you if quality factors are in line, right? Their 5-year price to earnings ratio, they want to see it under 22.5. It's 10.4. That's good. 5-year return on invested capital, 28%, which is great. They've grown their revenue over the last 5 years. They've grown their net income over the last 5 years. Shares outstanding are down 25%. That's insane. Long-term liabilities to 5-year free cash flow is under 5 at 1.93. Their cash flow growth is negative, so something to watch. I'm sure that's just some type of investment or something there. And then 5-year price to free cash flow under 22.5. It's at 8.86. So great scores in the 8-pillar analysis. And now what we need to do is come up with a scenario of a low, a medium, and a high price of where we would buy the shares based on what might happen with revenue growth, profit margin, free cash flow margin, price, and then what price to earnings ratio it might be trading at in the future, and then a price to free cash flow. We'll mostly pay attention to price to earnings ratio, right? Okay, where did I get these numbers from? Well, I kind of took an average of analyst estimates. This is from Ticker. It has estimates for revenue, for net income, and for free cash flow. Seeking Alpha has estimates for earnings growth, which earnings growth actually looks pretty strong from 2024 to 2027 in the 10 to high teens range, even low 22% there. Revenue growth is actually kind of going to be tough over the next few years, partially because of how strong COVID was, right? But also partially just because we're in a tough spending phase, right? Or a tough consumer phase. So not expecting it to go negative other than 2023, but then very low, 1%, 2%, 2%, and then under 2% growth in 2027. So the question becomes, even though the PE looks undervalued right now, it's got a great dividend yield. Is it overvalued based on kind of these low sales expectations? That's what this model is going to let us figure out. So for the low scenario over the next 5 years, this is a 5-year analysis, I have 1% revenue growth. This middle scenario is about what the expectations are, and then I did a low and a high above it. So middle is 2.5% revenue growth, and then high is 4% revenue growth. We've got profit margins of 2, 4, and 5%. Free cash flow margin just a little bit above that on the low side, the same on the high and the medium. And then a price to earnings, it's showing at 10 now right here. Low, it would be at 8, medium at 10, and then high at 12. If they grow a little faster and beat expectations, maybe it deserves a higher price to earnings ratio. Price free cash flow just did a little bit above PE because that's where it's historically traded at. And then desired annual return, we're looking for at least 10% because we can get the market average, which is anywhere 7 to 10% owning an S&P 500 index fund. Hit analyze, and this is what it comes out. So these prices are where we would be willing to buy the stock if we believed each of these scenarios to be true, the low, the medium, or the high. So on the low side, $39 a share. You can see it's at 78. So that's got some massive downside there. But if you think that the medium or the high scenarios are true, then you've got some really nice upside for a very solid dividend paying stock. So let me know in the comments if you own Best Buy, if you plan to add it to your watch list, if you might add it to your dividend growth portfolio. And let me know if there's any other stocks you want me to review. Thanks for watching. Have a great day. If you want to support the channel, you can do so for free in 10 seconds by liking the video and subscribing to the channel. That helps me massively and helps more people find us so they can learn about investing.